welcome Patti, Lawerence to Business Builder Camp. It's really good to have you with us to share some of your expertise. And of course, we've already done a little bit of kind of informal intros, which is how we work at Business Builder Camp. It's like we call this virtual campfire. So it's like sitting around the campfire, but we're joined today by an expert who has knowledge of a subject that is important to all of us. In this case, your work on financials and accounting, and the way that you explain that in your emails and videos is something I know is really going to help everybody here. And these conversations are always made better than by the people like Kane and Mike and Mark and Jamie and Dave who show up, because their questions later on guide it to the type of information that's really important for somebody building a business like they are. So yeah, thanks for being here. I'm gonna be quiet, let you take control of the screen, and we appreciate you.
Okay, awesome. Thank you very much. I appreciate that. Let me go ahead and I think I got a request to share screen here. All right, let's do this. All right, so I would encourage this to be a interactive presentation, which means, yeah, you guys just raise your hand. Because my screen has the limited number of people I can see at one time, if you digitally raise your little Zoom hand and use that control to do that, that would be great. Or you could put something in the chat, and Wayne, if you could keep your eye on the chat, that would be great. And just flag me down or interrupt me when there is something there,
Sure.
so that I can address it. So yeah, Business Builder Campers, what we're going to do is talk a little bit about planning and projections. What is that? I want to go through some of the different kinds of planning you can do, and then we'll talk about the biggest kind of projection there is, the most, I guess, the most used projection there is, which is budgeting. And then what I'd like to do is show you, I do some show and tell, so I can show you some of the ways that we do planning, and can show you kind of some, I call it scenario planning for one-off type things. One-offs can be, oh, maybe you're going to buy a building, or maybe you want to buy or lease something, right? Those kind of one-off scenarios, we want to see what those look like under different sets of variables. So let's go ahead and get started. If I can advance the slide, there we go. So business planning, it's basically, planning activities, but there can be different areas of the organization that will benefit. So in the overall sense, there's strategic planning. There's also cash flow, there's people planning, right? Even if you don't have an HR department, if you have, let's say, you're expanding your operations, you're doing a lot of, maybe you're going into a new geographic territory, maybe you're making an acquisition, you've got people planning to do. There's stakeholder returns. If you have any kind of equity partners, they're going to look for some kind of return, right? What is that's coming to them, and can you provide that? There's also growth planning for, because that's what we do as entrepreneurs. We're looking to grow our businesses. So what does that look like in terms of, that activity for you specifically, or for whatever else you're trying to do with your business? There's projections. Projections is a big kind of catch-all term, because you can put together projections for cash. You can put projections for, of course, your growth. It's the putting the numbers to the assumptions, right? So it's quantifying what those are going to be. And then there's capital planning. So you can't do your regular budgeting without putting together a capital plan. If you're looking for growth planning, expansion, those kind of things in your business, you're going to have to plan for capital expenditures. Okay. So I like to look at, what kind of business plans are there. So I call them special use plans. So they get into some fairly specific areas. So you've got your strategic sales forecasting, succession planning. That's a big one. So I think Mark probably gets involved with that a little bit at Compass Point. You're looking at succession planning, and usually companies don't have that. So I'm sure that, in your line of business, you're looking at that and it's not happening, among other things. There's contingency planning, right? Who saw the pandemic coming, right? Who saw the whole COVID situation coming? So contingency planning is more than just that. It's also maybe natural disasters. There's a lot of different things that come into play here. And then you've got I call it the garden variety budget. So everybody knows budgeting. Everybody's kind of heard of I call it the first and the last one, the bookends, strategic planning and budgeting. They're all really, really important, and they all kind of work together. So what do they look like? Well, these are just some formats of a few different ones. The one over here with the blue header, that is the one-page strategic plan out of Scaling Up. So that is a Vern Harnish product tool, if you will. One on the upper left with the orange, that one comes out of Traction. So it's their version of it. A lot of them, they have a lot of the similar characteristics of them, right? You're looking at here again, core values, right? Core focus. Okay, what's that? That's probably really close to purpose. Then you look at targets, right? This 3 to 5, this one up here's got a 10-year, right? So it's just breaking that down into and cascading it down into the bits and chunks that make it up. Also, what you're going to do is break it down into kind of who's responsible for it, right? So you'll break it down into task management. If there's anybody that's running EOS, they've probably done this. I don't know if it's called visioning, but some of that is really relevant to your organization, and it's really relevant to keep it up at least once a year. Like go back and revisit that. Then I have some of these here. These are just some of the different layouts that you can have: purpose panel, customer panel, operations panel, again, breaking it down into some different buckets. It's just a different look at strategic planning and the different ways to plan. Then we talk about cash planning and projections. So up on the left, we've got some techniques involved with cash management, cash flow management. On the lower left is a Scaling Up graphic, if you will, of the cash cycle. So you'll see it's breaking it down. The cash conversion cycle is the overall cycle. It's breaking it down further into 3 different areas: sales, delivery, and billing and payment cycle. And then you've got a sub-cycle of the sales cycle is if you have a production type facility where you're actually making a good instead of selling a service, you've got that letter B that goes into play as well. And from that, we look at, okay, so how do we actually put the projection together? What does a projection look like? This happens to be my personal favorite, and we'll get to it a little bit later as well, but the 13-week operating cash flow forecast. Why 13 weeks? Well, 13 weeks is a quarter. And 13 weeks, if you're dealing with anybody in the in your banking orbit, bankers love 13 weeks. So it's a 13 week and it rolls. So I would say when you start out doing this, start simple. Start simple, try for a couple of weeks, maybe try 1 month. I would say pick 1 month of actuals so you can see what the flow looks like, and then put one month of projections. So 1 month and 1 month, 1 month looking backwards, 1 month to do a projection, because you'll see some similarities in and repeats, right? So rinse and repeat. You've got the rent, you've got your medical, right? Your medical plan expenses. You've got payroll. However, if you're paying weekly, there's 4 of them. If you're paying biweekly, chances are there's 2 of them, right? So you're going to see some of that repetitiveness, and it's going to help you think if you see it all on one sheet. Okay, so that's cash planning and projecting. Then there's the whole growth planning. So my recommendation for growth planning is you do it as part of your strategic plan, as like the next level, right? The next level down. So once you devise that goal and direction that's in your strategic plan, then you look at kind of, okay, how are we going to get there? If we say we've got this hockey stick, right? We know what a hockey stick looks like, hockey stick of growth, then, gee, how are we going to do that? So we have to look at some things here. So the right hand graphic is from traction in EOS. The left hand is out of scaling up. So I've got kind of my favorites and pulling them in. So, you're looking at driver demand. This is the 4Ds. I talk about this in some of the things that I put out, not only on audio, but video. And my so I had a podcast, and I've got my twice monthly newsletter. So these are the things I talk about, the 4Ds. What are those, and how do they influence your growth? Right? And how do you leverage those, right? Take those into account. Disciplines. Yeah, that D, right? Nobody likes the word discipline because, it makes you think of a parent and a child relationship, but there's some level of discipline that has to go into your planning process, right? Same with data, same with people. You got to have people to fuel your growth, right? To make your growth happen. So these are the kind of things that need to be taken into account when you're talking about your growth planning. Then you've got this ugly thing, right? Who's in charge of sales, right? Sales forecasting. Do we ever do it well? I don't know. Sometimes we do, sometimes we don't. Sometimes it's really, really difficult because your customers or clients say they're going to do something and then kick the can, right? So you say, hey, they say the order's coming, and you're waiting and you're waiting and you're waiting, and never comes in, right? Or they just don't pull the trigger right away. So these are a couple of different ways to do your sales forecasting. One is more on the demand side, which is the right-hand side. And yeah, you can do all of those things. Sometimes it's just like, okay, well, what did we do last year? And can we do it again? Or can we do better, right? And are we marketing against that? Are we putting marketing dollars against any of those initiatives or products or services that you see on the left-hand side, right? So this just happens to be, whoops, I'm sorry. My cursor's going nutty here. So on the left is an extract of a spreadsheet that's going to allow you to do some of that with, using some math, right? Using some math rather than kind of doing that. You're going to do a little bit of math to get to what is that revenue number. Okay.
Patti.
Yeah. Did you have something, Wayne?
Yeah. Maybe at what point will you like, I should ask you this in the right in the beginning, but at what point do you want to stop, and is there a conversation, or you did say like ask questions along the way?
Raise your hand and I'll stop and we'll go over it.
So I have a question.
Yes,
Can,
of course.
can you go, I mean, this one ties in, and can you go back to the cash flow projection on the
Yes,
cash planning?
this one.
Yeah.
Mhm.
So when you had that one up, the note that I made, which has to do with like, thinking about was on my screen, Kane and Jamie are next to each other, and I think about them and what they're up to and how they're building things, and everybody else too. But I can see them on that pop out. And I wrote, get a feel for cash flow ongoing before you do a growth plan and then have to do cash plan. So what I observe in business owners, and I've experienced this a bit myself on this one, even when like having a farm, for example, is there's a certain feel certain CEOs and business owners have for cash. Like they can feel it, they feel it coming, and they have people like Dave Ricker, who's on staff CFO, and then you sometimes as a outside, but integrated to help feel it and put the numbers together. But I wondered, like, can you comment on business owners getting that feel for cash in and cash out, where it's going, and
Sure.
what's ideal or what's best practices?
Well, I think that there's a couple of questions in there. How do you get a feel for it? I'd say this is the best way to, I mean, you can have a feel for it without putting this together, but putting this together is going to really solidify whether or not you're feeling really what's happening. Does that make sense? So I would recommend having somebody in your organization, whether you do it, whether you, and I have this to share with everybody after. I'd say lay this out, even if it's just on a monthly instead of a weekly basis, so you can really see on that whatever frequency you choose, which is appropriate for your organization. And I would say, start out with monthly. And if you're not getting the right granularity because you have these huge swings in your cash, then you're going to want to break it down even more granular. So weekly. So if monthly's not telling you the story, then look at weekly. Weekly will definitely tell you the story, especially it's going to be driven by your payroll. Payroll is typically your biggest expense as an organization and your biggest outflow anyway. So what you're going to want to do is see what that looks like, because that's where a lot of the choking points are in our businesses. Is all of a sudden we don't have enough payroll, and it gets to make payroll, and it gets our attention really, really fast, and it freaks us out, right? That is the number one freak out, right? In the entrepreneur's life is, are we going to make payroll? So once you lay this out, and this is a checkbook. This is nothing more than a checkbook. So you won't find depreciation in here because it's not cash, right? So you're really analyzing what's going on in your cash accounts. So what do you have coming in and the timing of it? What do you have going out? The timing of it, right? And the other thing you get from this analysis after doing it for a little bit of time is during those tight periods, one, you can see them coming, right? You'll be able to see them coming. And I'll illustrate that in our exercise at the toward the end. You'll be able to see that. And when you see it in the model, the big question is, what do you do about it? What can you do about it? Because you have more control than you think you have as a business owner. Okay? You do.
Thank you.
So does that make sense? Does that answer your questions?
Yeah, and there is no just one right answer, right? But it's more like just slowing down and taking a look at that, because It's
Yeah.
important. And it triggered off of sales projections. And how do we ever really know? And that's a seat I was in, was director of sales. So that one I have more familiarity with. And what I found is like, over time, same thing, like over time, as you work to do projections, more often they come true, and you can push a little bit, you can stretch a little bit when you've done it for a while and see how you're going to make it happen. So, no, that's good. Thank you.
Yeah, of course. Of course. All right. So yeah, that was sales forecasting. Then we get into business contingency planning, right? Again, there's a couple of ways to do this. I've developed a checklist which is on the right, which I will provide to you. You don't have to try to scribble this, please don't. I'll have this for you. But really, business continuity is huge, right? If COVID taught us anything, is we need to have some of this, right? Maybe you're not in, no, I can't say that. I mean, you may not be in an earthquake zone, but do you get tornadoes, or do you get flooding, or do you get, anything like that, or, pandemic? Who's stopping? I mean, there's no stopping that. That just happens, right? So there's those kind of things to take into account. And, let's at least, it's a cursory review of the thing might even give you one aha, like, oh, that's brilliant, we need to do that, right? Even if it's one, it's perfect, right? It's for you. Then the other one is, just a breakdown in a graphical representation rather than a checklist, but all of the things that can happen, right? If you look at the top upper part here, natural hazards, geological, landslide, earthquake, volcano, right? Okay, we might not have that, but maybe you have a supplier that, right? Maybe one of your suppliers could get hit by that. Then you go, oh, geez, could have had a VA. What do I need to be doing to prepare and get a second supplier? I need to be dual sourced in some regard, right? Or my people, right? What happens with my people, right? So it's good things to know. Do you have to have it to the T? For smaller companies like ours? No, but awareness is where it's at. Okay. All right, then we get to the big one, budgeting. We love budgeting, right? So budgeting, it's a broad topic, right? If you look on the left, there's 10 different types of budgets you can put together, right? Or hold somebody else accountable to put together for Dave. Dave just says, hey, get me my, labor budget, or you need to get me this budget, right? Or what's the capital budget? Somebody needs to get it for me, right? Get it to me. That doesn't mean it's approved, right? Because we need to know the cash that's coming in to be able to support a capital budget, right? So when they say master budget, I just don't like that word, but it's really the consolidated look at the budget from all perspectives. So it's a financial budget. Everything's financial when it comes to budgeting. It's just that there are events and opportunities and other drivers that you have to translate into dollars, because a budget is bottom line dollars. It's dollars and cents. So, how are we managing that, and what goes into them, right? Yeah, there's a sales projection, or there's a sales budget, but in order to translate it into the financial budget, you have to time it for when to, how long are your terms, right? This says collections. So hopefully you're collecting 100% of it. It's just the timing that's, you don't know, right? But that goes into your cash budget or cash flow budget, right? What does that look like? Then it flows into the balance sheet. And so you've got all of these working in concert. You think budget is just one piece of paper. Well, there's a lot of moving parts, right? There's a lot of variables that have to be quantified, right? And a set of assumptions around. as well. Any questions on this one? I know this is, I'm going pretty fast, but there's all good stuff here. All right. So, what is budgeting? Well, it's a roadmap. I like to say it's your GPS for the year, because it actually quantifies what you've got in your head, right? As a business leader, you have to take that and make it into dollars, right? Quantify it. And then it gives you an element of control throughout the year, because it sets up your benchmarks that you're measuring against, right? I like to say it also reduces risk, because you've put a set of assumptions together of what you think the business is going to do this year, and you're measuring against it. So that in and of itself is going to provide some level of risk abatement for you, because things that don't belong, overspending, underspending, you're going to see that based on what you've put into that. And I like to argue as well, it enables faster decision making, because you spent all that quality time. I say all that time, but you thought about these things previously, right? You thought about them before you started the year. If you're a fiscal year or your calendar year, it doesn't really matter. You've done it prior to the year starting. You know what those decisions are. You know what your assumptions are. So that when something comes up, you go, oh, we didn't have that budgeted, but can we afford it? Well, we're running ahead of budget, so I think we can. I think we can, we've got enough cash to be able to, put that into play, take advantage of that. Now, why do we do it? Well, of course, we're at least planning for 1 year, right? Planning for the future. And by the way, that plan ties into our strategic plan. Because strategic plan, I like to do 3-year strategic plan. So if you're doing the strategic plan, year 1 is your budget. Year 1 financial part is your budget. You're also using it for cash flow management, for banking, right? If you're going to go out and get any kind of a loan, do any of that kind of stuff with the bankers, they want to see what you're doing. They want to see, what you have been doing. They'd like to also see what you think you're going to do this year. And again, you have the ability to respond to unanticipated events, evaluate your performance. I say track and monitor waste. Waste is pretty much anything that's leaking out of your business, right? I say leaking because it's like a leaky bucket that you need to plug, right? So it could be labor inefficiency. It could be if you have a product that you're making, you could have yield loss. You could have all kinds of losses in the manufacturing portion of it. Those are the types of things that you want to be able to identify, right? And you can track it over time. Trends, right? Trend analysis. So how, right? How do we come up with this budget thing? So I want to say it is a little bit of art and a little bit of science. So we're looking at past performance, because unlike investments, so if you work in the investment world, they say past performance is not an indication or a guarantee of what's going to happen in the future. Well, guess what? Usually it's a pretty good indicator in your business of past performance is really good indicator of how it's going to go forward, how your business is going to move forward. If you do nothing, right? If you do nothing, you're probably going to get the same result, right? But we're better than that. We're going to do more, right? So we're going to also look at previous budgets. And by the way, how do we perform against those previous budgets? We're going to research a little bit, right? Are there economic trends out there that we need to take into consideration when we do our budget? Is inflation, right? Is inflation on the rise or is it on the decrease? What are labor rates doing, wages doing? We have wage inflation, or are we getting to a point where we can breathe and we can hire people and it's not breaking the bank for us? I always advocate for keeping it simple. Let's not over engineer our budgets, because we have to measure against them at some point in time. So what you don't want to do is create something really, really complex that you can't recreate and measure against. So let's try to keep it simplified, but make it measurable, right? It has to be measurable and impactful, right? We want to be able to impact it. We want to impact not only our bottom line, but we want to make it impactful for who do we serve? Our clients? Do we want to serve more clients? Do we want to serve a new geographic region? What are our growth plans? And how do we tie that budget into those growth plans and the strategic plan? Anybody can do this, right? Because you know your targets. Who doesn't know their top line target for this year? Raise your hand. I don't see any hands. Of course. Oh, Kane, did you just raise your hand? You don't know your top line target for this year?
Nope. We don't have one.
You don't have one. Are you flying blind, or tell me
We're
a
not
little bit about that? I'm interested.
We're not flying blind, but we had a big year last year. And well, so I guess we do have a target, because we're really just shooting to do the same revenue we did last year. We're just looking to increase our profit and doing the same number. So we're focusing more on efficiency and profits than we are on that sales target number.
Yeah, of course. But you know what it is. Okay, good.
Yeah. Okay.
I feel better. I feel good for you. You do have a target, even though it was not a number. It's basically same as last year. So good for you. That's exactly a target that I like to hear about. Let's not focus on the top line. Let's focus on everything else, which is spending, doing it more efficiently, doing it. Yeah, all of that.
Yeah, absolutely.
All right. Strategy. So we're looking at strategy as well. You guys know the strategy, right? You know what your strategy is, especially if you're doing the strategic plan, right? That needs to be wrapped into it, right? Needs to tell the story. I like to say grow, divest, or exit, right? You know what you want to do, right? Are you growing the business? Are you growing to sell it? Are you growing to exit at some point? What are those things? Because that's going to change your trajectory, right? And you should know that from your strategic plan as well. Also, what are the controllable variables? I hinted on this a little bit, right? What's within your control? And again, I want to give you guys credit, because there are way more things within your control than you think there are. And we'll talk about that when we look at those models. And the big one, renegotiation. Everything's always negotiable. Everything. And COVID kind of taught us that, didn't it? The people were renegotiating a lot of things, real estate especially. So if you're in the real estate business, that was a little tough. But especially with people exiting, working from home, all of that stuff. So always know that is a lever for you to use, right? Supplier renegotiation. Yes, please. All the time. Banks too. And then pulling it all together, right? we need to pull it all together and look at it in the holistic sense of what is that for our company, right? What does it look like? And does it make sense? And if it doesn't, then we got to do some tweaks. So what now? What do we do with that budget? Well, measure and manage. I love measuring and managing, right? Because it's a cycle. We'll talk about that in a sec. We'll reassess. Oh my gosh, what did we learn from that process and what can we do differently? We can question expenses, right? What the heck are we spending on that? Right? So how many times do we have, let's say, memberships or subscriptions that are on auto debit or auto charge, right? All the time that we need to go, hey, wait, we aren't using that anymore. We need to cut that kind of stuff. We're making better decisions and faster, and we can respond to whatever pops up, right? And then we get into updating and forecasting because stuff happens, right? We're in June. Has anything happened the first 6 months of this year that's different than what you thought was going to happen? Well, heck yeah, of course. So let's make an update, and all we have to do is tweak it going forward. So here's the cycle that I talked about. This is the cycle that we look at, right? Measuring and managing. So here's the measurements. Again, what's important for your business? We translate those usually into KPIs, right? We have reports, but to simplify it and get a snapshot, we're looking at KPIs. Then we communicate that to the organization. Feedback is essential. Then we have to monitor, right? Which means we're paying attention to it on a regular basis, right? We're not just like, oh, once a quarter, oh, look at that. That's nice. No, we're looking at it on a regular basis. And we're looking at it versus benchmarks or targets, right? Versus our budget. We're looking at it. And we see trends. Trends are another way to benchmark things because it's over time, actuals over time. So we're looking at how are things evolving over time to see if we can spot something that's out of whack, right? Are we spending too high? Are we spending too low? Those numbers always tell a story. If they're formatted properly, they will tell the story of how your business is operating and performing. We'll calculate those variances, analyze them, because we're asking why. The analysis always begins with why. Why did this happen? Why is the number this way? Because we need to answer it with the root cause. What is that cause? Because the next one is we need to take action, right? If there's a root cause of an issue that's detrimental, then we need to fix it. Or we need to stop it. I say practice abstinence. That's stop it. Stop doing it, right? Or we have to figure out by trial and error, what is the issue? Well, if we did this, especially if you have manufacturing operations, we did this, then this would happen, right? So it's cause and effect, trial and error. So we kind of keep tweaking it to see if we can get a better result. That's course correction. And then we need a coach. We need to feed that back into our organizations. We need to explain what these changes are, why we're making these changes, especially if you have a manufacturing operation, right? What do we need to do differently to make sure that we're performing at our best? And that's when I'd say encourage empowerment. So, like Emmett here, we're so pumped up, right? Let's do this. We got a budget going on here. So what do we do? Oh, I see there's a chat. Okay, I'm going to stop. There's a chat. Oh, Wayne, there we go.
You're good. It's just,
I'm gonna stop for a sec.
yeah, you're good. It's just we had worked on Jim Collins's flywheel at an event that some of us were at, and your process there really makes sense.
Got it. Awesome. I'm just gonna bring my Excel stuff up because I just can't get enough Excel here. So this is kind of I call it the hands-on part. Hands-on, but not hands-on. It's more demo. But really it's into the scenario modeling. So what is scenario modeling? It's kind of like what ifs, right? It's really putting together and Excel's the best way to do it, unless you have a specific tool within your maybe your ERP system that allows you to do some modeling based on given, how you've been performing, and then a couple of variables that you get to tweak in there. But this is basically something I did over COVID, actually, to give people kind of an idea of what could they do given the situation and what was in their control. So there's a couple of things. It's basically top three, right? So identify your levers. Like, what can you actually control in your business? What can you dial up or dial down in your business that's going to help control your financial results? Okay. Then I call them BAMs. And I don't know if you guys swear, but sorry. It's called bare ass minimums. So these are the bare minimums that you should know that you need in your business, right? And think about during COVID, like we needed to do cash conservation, right? Shutdowns happened. Businesses were shut your doors, right? So how do we conserve cash so that we can come out of this on the other side, right? So those were the bare minimums. And then the third one is, everything's in a construction zone. So construction zone means it's always under construction. It's always a work in progress, right? So just be prepared. Be prepared for changes that you can bring into your business that might elevate them or upgrade your business, right? From a cash standpoint, from a profitability standpoint, from an employee perspective, whatever those are, right? Because they were flying fast and furious during the whole shutdowns time. So the first thing I want to do is share with you. You don't have to memorize this, by the way. Please, it's just for demonstration purposes only. I'm just demonstrating what you could do, right? What does a CFO kind of look at, right? And how do we look at this? So this just happens to be, this is old data. It's actual data from a company. Names were changes to protect the innocent. And it's a manufacturing company, so they've got materials, labor, referral fees that they pay. They've got your, expenses down here, overheads, all the overheads, insurances, blah, 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 travel that went to zero. And then all the way down here to net income. So they've got net income here. They do have depreciation, which is up ahead. So up in alphabetical order because it came out of QuickBooks. So that's how their stuff works. But what I did is I drew a little free cash flow from operations. It's actually not operations. It's actually got the referral income in there. So, because people are paying us referrals. So I'm going to take that. So this is kind of the free cash flow. And this is obviously pre-COVID. So pre-COVID and then after, COVID hits. So I want to just have you look at, how do we do these, projections, right? And I would say start with something that's representative of your business. And this happens to be representative of the business that we were working with at the time. And it went all the way out to, okay, so here we are impacted, right? So what I wanted to do is say, okay, how can we project into the future for some unknowns, right? And knowing that there's impact, right? There's a lot of different ways you can, like Kane was saying, is same as last year. Okay, well, we could do that here, but if we're impacted, we got to make some different choices, right? We got to make some decisions. Since we're impacted, we can't just go back to April a year ago. April a year ago would have been, oh, let's see, 685,000. Ooh, that's pretty zesty, right? Well, that's not happening. If we're shut down, we're lucky we're going to get some money in, right? Or we say, to Kate's point, oh, same as last year, 600,000. Let's do it. All right. So I'm just projecting, forget that it's 2020. Doesn't matter. It's this April, this year versus last year. And then I know that our job materials are running at, if you see this over here, 18.75% of sales, right? Because I know we're almost always in that range, and our labor 21.3%. We know that. And if you have a service business, obviously you would leave out the materials, right? But you would still to figure out what your cost of client delivery is. What is the cost of that? And it's not 100% of your wages, guaranteed, right? You should be, if you're not, you should job cost. And I say job cost, meaning if you work on clients, you should be allocating how much time you spend on per client so that you understand, are you making money on a client? Or are you not making money on a client? Right? Because a certain percentage of your labor is going to be client delivery. And maybe some of it is administrative. Maybe some of it is business development. It could be pretty much anything. Right? So we want to make sure that we understand, is our productive labor productive enough? Right? So what we do here is we come down and say, all right, we've got our cost of goods sold. For that, we're saying we're going to still promote. We still need to do promotional, we still need to do that. But you know what? That's also one of the things that we can control. Can we control that? Yeah, if we're doing Google ads, last I heard, you can tell it, or Facebook ads, you can tell it how much you want to spend. And you can pull that down. Now, media buys, that's a little different. I get that. But the question always is on the BAMs, what can you control? How much of that can you control? Can you control half of it? So when you're looking at this particular scenario planning, ask yourself on each line item and be brutally honest, as if it's me asking you, right? You got to be honest, because I'm gonna pick you apart. I'm gonna ask you some tough follow-up questions, right? Well, what happens if you just didn't write the check, right? What happens, what happens if, right? Or my favorites, the 2-year-old question, why? Anybody got 2-year-olds at home or had one? Yeah, they ask that all the time. Why? So that's what you have to do, especially when you're being challenged, right? When your business is, being financially challenged, or even better, when you're in a position that you would like to be setting aside more cash for something in the future, right? So say we're saving up, we're building a reserve because we need to have 20% down on the new building, right? That's what we want to do. We're questioning expenses. We're questioning why. And do we really need it? Right? It's almost like building a budget from a zero-based budget where you build it up instead of taking last year's expenses and going, yeah, that's good enough. Right? You want to question those. And then there's, the requisite compensation. So you're going to have to know how much your people costs. And this has got it in a few different buckets. So it's got, your admin wages, your owner's salary, taxes on top of all of that. And the taxes are everything, including your direct labor. Then you get into some of these overhead expenses. So continuing education, question that. Are we getting the bang for our buck? Are we getting the bang for our buck? And how do we measure that? It's no different than your marketing and advertising expenses. Do you have ways to measure those? And prove to yourself that you're getting the return that you want. That's the big one. Are you satisfied with the return? Are your shareholders satisfied with the returns? Right? And if not, how long do you give it? Because I've heard that before too. Yeah, we're not so, we know we need to give it some time. Okay, cool. How much? How much time do you give it? Right? And once you have the answer to that question, put a reminder in your calendar. Put a reminder on your phone. If it's 6 months, put a 6-month reminder. Revisit. Because that is the time that you're going to be forced by me or somebody else, right? Who's holding you accountable? So let's make that decision. Fish or cut bait. Is it time? Is it time to do something different? Then we have things like insurances. When was the last time you bid out your insurance? I'm trying to give you guys ideas. The things you don't think you have control over, you really do. When was the last time you did a competitive bid? RFP, if you will. Go get three bids, right? For your insurance. It's worth looking at. Or workers' comp. There are pay-as-you-go plans. There are pay-as-you-go plans out there. Captives, depending on your size, right? What's right for you? Then we've got meals and entertainment. Are you using that to keep your people happy? Right? Do you use that as, the minister of happiness? Right? You buy pizza on Fridays. Do you maintain a coffee station? Whatever it is, right? How is that used? Then there's consulting. This is always the target line, right? I worked 20 years in the corporate arena, 20 years in corporate. That was always the first one that came up. I'm like, okay, that's the only one you can focus on. Sometimes it is. Sometimes you have to renegotiate a contract, right? Back to what are our levers, right? What levers do we have? We also have tools. Tools are renegotiation, right? Same thing with rent, right? What do we have going on with the rent? Retirement plan, wages and retirement comp and benefits. Those are likely not negotiable, right? And you cannot not pay that, right? That's your first contract obligation out of every expense on here is your people, the employees that you have, number one, right? Then we've got some other little bits and bobs there, but again, when was the last time you guys looked at your projection or your P&L top to bottom and kind of did, let's call it a scrub, right? Scrub. And when I say scrub, I'd say go to that number right there. That's advertising or promotion. And if it were actuals, okay, let's go back to February. February is an actual. So go back to the last actuals and do a dump, right? By vendor, by who we paid in the month to see what are we actually, what's actually running through that account, right? Do we really understand that? Right. And I would say at least once a year, do that mid-year, maybe end of the second quarter, going into the third quarter to really understand what's going through all of that. And you can, typically your financial people can get that for you. It's a pretty easy report to get, they say. Cross your fingers. Okay. I don't know what everybody uses. Okay. Yeah, I'm not sure what software everybody uses, but for the most part, they should be able to pull that. Okay. So the last piece I had is we'll call it the tab for the cash forecast. So this is the one that's that I did a little cutout of, a screen cutout. So again, I love Excel spreadsheets because of the flexibility it gives you. So the flexibility here is to, this is basically your checkbook, and you're projecting your checkbook. So you want this to really tell the story of what you're spending month in, month out. So when we say sales, this is, you got to, okay, it says sales there, but it says cash receipts from the sales. So this is basically your inbound accounts receivable payments. So it's the checks that are getting deposited from your customers that are paying you. So again, remember, this is cash, not necessarily what's your accrual based, if you are, or cash based on the P&L. But this is what's coming in from your selling activity. Then, you might have something else here, interest, whatever, but this is all cash in for the week. This is a week, right? So these are individual weeks. And this is what actually happened, right? So these are projections out here intended to be. So you can see, again, job materials. Yeah, we paid a vendor 25 grand, right? We paid some contractors. Oh, it was a payroll week. Oh, here's a thing. We pay payrolls every other week, right? Bi-weekly. So again, the layout will drive how you kind of think this through, because we've got 4 weeks of actuals laid out right there for you. And then rinse and repeat. Okay, we're in the 73, 74, 73, we're right in that range. So, yep, just copied that and said it's going to be kind of more of the same. Maybe this one had some overtime in it. It's within spitting distance. Same thing here, marketing and advertising. What does that look like? Oh, commissions. Oh, looks like we pay them middle of the month, right? Once a month. Okay, got it. Taxes. Ooh, yeah, okay. There that is. That's our 415 probably tax. We want to get that paid, right? And so on. So you guys kind of get the picture here. Okay, we got debt service. We're paying bi-weekly. So we're paying down is probably our line, right? So we're paying our line down over time because we needed the cash at one point in time, and we're just paying it 20 grand every other week. That's what that tells me. Same thing with credit cards, right? We're paying balances down, right? Trying to get rid of that. Then we got owner distributions. right? We're paying $10,000 a month, right, to the owner on distribution. So what does that all look like in the end? It's showing we had a few weeks of the negative means it's actual reduction. It's more cash going out than coming in a single week, right? These are all standalone, right? At the bottom, that's cumulative. That's what's in your account at the ending balance. So what does that look like? So our projections here say, okay, that first week, oof, we're going to be upside down. We're going to need to spend more cash than is coming in. Ooh, boy, we got two more weeks of that, which means we are having a precipitous decrease in our balance. So again, back to my comment earlier, if we can see this coming at us, meaning these negatives, what can we do? What levers can we tweak and adjust to help us out? Maybe we don't have to pay that credit card until we get more in, right? Until we get more collections in. And what I'm not showing here is your accounts receivable, right? If you've got accounts receivable that are aging like a fine wine, I suggest you get somebody in your organization to start dialing for dollars. Meaning, do not let your invoices get very, very old with your clients. Those need to be paid. As if you've delivered your revenue promise, right? If your company has delivered on your revenue promise, do not let those things go past the due date. You need to get on the phone immediately, understand, somebody needs to, whoever has the skills, right? And I don't mean threaten them. What I mean is, hey, maybe you guys lost the invoice. Hey, maybe this happened. Maybe somebody's on vacation. Hey, just checking in, right? Seeing that, a little late on this, the due date's come and gone, right? What does that look like in your organization? It needs to happen. I will tell you that. I will say, some companies, unfortunately, will be intentional about that, intentional about pushing off and not telling you. Okay. Especially big companies. Big companies are really bad about that because they have the big bureaucracy and they'll blame it on somebody and, oh, it's sitting on somebody's desk in somebody's desk drawer or, whatever the case is. Hey, Kane, what do you got? Question. Thank you. You popped right to the top of of what I can see. Thank you for doing that.
It works.
Yes.
So in terms of receivables, right? Receivables are a thing
Yes.
here in my company. We do
Mhm.
because we're not a time of service company. So we invoice for whether we're doing service calls, construction, everything is invoiced. We don't do any COD work.
Okay.
So receivables is something I pay very close attention to. So in this exercise that we're going through, like how much of my receivables would I consider cash? Is that just something I have to figure out? I mean, we generally collect let's say at the end of the year, we collect 98% of our money.
Mhm.
But with contractors, people who build buildings and houses, sometimes money goes out 3 months, 4 months, 5 months, 6
Mhm.
months, a year, because if they don't get paid by a client, which is always the number one excuse,
Yep.
we don't get paid. So
Pay when paid. I get it. Yep.
so how much of my receivables, or is there like a column that I should use to call my cash?
Yes, that's a great question. So what I would do in the model is, let's say, take this number, take your projection
Mhm.
and maybe come down or put it on another schedule and break it down into how quickly you your company collects or how quickly you are paid from the sales that occur in that month. Okay. So let's say they're $500,000 in January. You're not going to get that cash in January at all. If you have 30-day terms, you could probably, law of averages, you could expect half of it in February, half of it in March, because it probably happened equally over the month. It's whatever your assumptions are.
Okay.
I've done some pretty crazy that violated my keep it simple, but those were in the corporate days, and I was expected to do that. I was expected to get very elegant with my model. But you would break that down, that 500 for January, you would break it down into when do you think you would collect the 500? And what I would do is break it down on a percentage basis, right? And schedule it out. So if you say half of it's in February, half of it's in March, so you would start out your cash collections, right, from sales in February with 250. And then the other 250 would be in March. Does that make sense?
Yes, it does.
And that's if they paid on time. If they didn't pay on time, you would say maybe 90% of that is split 50-50. And then the other 10, I don't know what your percentage is. What you would need to do is have somebody in your accounting department there give you some of those statistics, right? So how long does it take? And if you have 30-day terms, you can, base it on 30 days, right? And you could prorate things.
Sure.
Does that make sense?
It does. Yeah. I watch our receivables. And every week I chart them. I chart the aging out as a percentage of total sales. So like, I know, and it's one of the things that I watch in receivables is how much is current versus all the way out, over 120. And I watch those
Right.
percentages and I share them with the team every week. So I have a good sense of when those percentages move, I have where we're going to be with cash.
A question for you. Who in your organization makes the call to the customer?
So in our service department, we have one person who's in charge of the billing, and she's the one who calls on all the clients because she's the one who made all the bills, the invoices. And when it comes to our construction, 6 sales engineers, let's say, and they all call on their own accounts. So if a contractor owes them money or a client, they're responsible for tracking it down.
Okay, great. Sometimes that's good and sometimes that's bad.
I agree.
You get both sides of the coin. Sometimes some organizations want, let's call it a third party meaning somebody who's not selling, right? You get the carrot and the stick, right? The carrot, ooh, you can't be tainted asking for money, right? Because you're selling. So we'll give it to the accounting department or, whoever, right? Or customer service or, whoever. And so, but they might not understand the client situation. So you've got both sides of the coin there. And sometimes it's just, okay, hold your nose and pick one because it's tough. Either side of it's tough. You've got basically advantages of both and disadvantages to both. I've seen it both ways. And I think it depends on who's chief in charge.
Yep. Yeah, I agree. I mean, sometimes my partner is one of our sales engineers, but with relation to the other sales guys, sometimes he gets involved. If one of the guys is having a difficult time, he'll get involved, or sometimes I do. But for the most part, we're okay. And when our money gets old, when our receivables is old, we usually know why. There's not too many instances of somebody just completely ghosting us on it.
Yeah.
clients usually will offer an explanation or pick away at it over time if they're struggling.
Okay, well, that's good. That's good to
Yeah.
know too. Okay, let's see.
We, Patty, and I see Jamie's hand. We have
Yeah,
like
of
14
course.
minutes. We're about
Yep,
14
of
minutes
course.
left.
Yep.
And yeah, so yeah, maybe Jamie, and then looks like you have bonus materials. And
Sure,
Mark,
yeah, of course.
Mark, if you have any questions afterwards or insights, we'll get any of those too. Sorry, go ahead, Jamie.
Patty, in the profit and loss, is there any ratio that can be looked to? So I'm looking to expand, possibly purchasing another building. Is there
Mhm.
is there a certain ratio to look at as far as saying, okay, you have a green light to move forward to do some of those other things?
You mean in terms of
Health,
needing
overall health of the
capacity?
business, and okay to move.
Okay, sure. So what I would look at is your free cash flow, right? Because this right here, and it's this one, it happens to be a pretty simple calculation. So it is basically your net income, and then actually it should be plus. I had it going the wrong way. It should be adding back your depreciation. Sorry. So that's going to be your the number that you should look at, because what that does is it shows you on a monthly basis what kind of cash your business happens to be generating each month, right? What kind of, I call it printing money. Are you printing money each month? Or are you kind of doing this up and down, up and down, up and down? Or is your business cyclical? Do you have I'll call it a busier season than a certain time of the year, another time of the year? Probably for you, not so much. I don't know. I don't know your business well enough, but
We do actually. We're busier Thanksgiving to Valentine's Day.
is that right? I would have never thought that. I thought you would be pretty, sorry, flatline. Sorry, that's a bad joke. But it would be, I thought it would be pretty even. So what I would say is really understand what kind of cash you're generating in the lower sales months, if you will, the less busy months than you are in the busier months. Because what's going to happen is if you take on that project, you're going to want to make sure that your cash flow, right, your free cash, which is kind of this number here, that free cash flow can support the debt service and or down payment, right? If you're doing an expansion, it may be a 20%. Usually commercial real estate is 20%, right? You have to have a big nut to be able to make that purchase. And, the bank is in for 80% loan to value. And then if you have any leasehold improvements or anything like that have to be made, that's got to be taken into account as well. Did I answer your question?
Yes, thank you.
Of course.
Well, and then Patty, isn't that also where if Jamie were going to do a new building, for example, there might be a 12-month build out or something where he would have to model, assuming no new cash flows coming in from the building. But then after whenever he plans for, you would assume that there's a reason you bought the building and that should be generating cash and modeling that out.
Exactly. So what I would do here, Jamie, is in a cash flow forecast, when you would put that together, down here in the disbursements, Obviously, you would want to make known what the debt, and this says debt service in here, but what kind of outlays you're going to have. You're going to have engineering costs, you're going to have excavation, and maybe that's not GC. I don't know if you've got a general contractor and things like that, but for sure, you're going to have legal and permitting and engineering. You're going to have a lot of those expenses that aren't, directly, loanable, right? They aren't going to be under the loan. You're going to have to fund those. So you want to make sure you capture those in here, because that's going to have to be funded out of your current cash flow before, like Wayne said, before you get $1 of revenue from the new location or the expansion of your facility. And a lot of times they'll go with a construction loan. So you have construction draws that'll marry up with how you pay your GC, right? So that won't hurt you as far as cash flow is concerned, but those upfront costs are what you need to take into consideration. Anything that's not going to be funded by the loan.
Thank you.
Of course. Anybody else? Any other questions? I love questions.
Mark, do you have any insights today? Anything that popped? Anything that was helpful? You're on mute.
Yeah, the whole process I think is helpful, just understanding all the different things to look at in budgeting and planning. I was intrigued by the Thanksgiving to Valentine's Day peak as well, but I didn't realize that.
Yeah, we've all been working on plans to grow Jamie's business, but it could land us in jail, and it doesn't seem ethical, but.
You're trying to smooth the demand out a little bit, huh?
I was thinking the last 2 deaths in my family haven't happened in that time period, so I'm going to be extra cautious between Thanksgiving and Valentine's Day next year.
I love that. Me too. I've learned that too. But what I wanted to offer, and I'm going to email these to Wayne, is some files. I have bonus materials for you all, and whoever else might be interested in them. Wayne, I'll send it to you and let you distribute as you see fit. That one-page strategic plan, the Excel spreadsheet for the rolling cash forecast, the continuity checklist. I have a tool for pricing for profitability, which is always helpful if you have the data. It's also good. It's good for, I call it I don't want to say post-mortem, but sorry, Jamie. But that's after the fact, right? To look at a job and say, or, whatever it was, and really run it through this tool and see, like, why were we off, right? Compare it to what we thought we were going to get, right? So when you price something out and then you actually, like, say, produce it or deliver it or whatever it is, whatever the case is for your business, you look at how the actual profitability came through versus how you priced it. Sometimes that's an eye opener. So this tool can help with that.
These are great. We'll get them to everybody, and then the slide deck too, right?
Yes, of course.
So if we take the
Yeah, of
slide
course.
deck plus the video, I'll keep that to share Patti with other people that couldn't make it today. And then separately, I'll reconnect with you so we could do a quick, shorter Zoom call on how you work and how you partner with companies. I'd like to be able to add that to our library that goes with this slide deck. And it's easy. It is always easy that and Jamie probably is getting tired of it. It's just, he has a business that is easy. We've all experienced it as part of life, and we're all, like, appropriately, like, uncomfortable, I think, with the topic of of death, but yet we like to like kind of play with it. And that breakdown, the post-mortem thing you just mentioned, like for Kane has been working on per job profitability in the HVAC industry. But when Jamie and I first started working together, we did sit in my building, right, and talk about his two primary products and services that he offers are, kind of old school funeral with embalming and concrete vault and casket and all those things. Or like the more, modern and trendy cremation, and it changes like his whole business. There's a big change in his industry because of those societal trends. And we can and should break those things down, because those are the building blocks of being able to buy a new building, for example, right?
Yep.
So there's a lot here that you've given us, and I appreciate it. And I saw everybody kind of making notes, and it's more complex than you can ever cover in the call, right? But this has been helpful.
Yeah, of course. Yeah, feel free. Reach out to me if you have any questions or specific situations. I'm happy to chat. I did that all through COVID. Anybody who needed it, I want to make sure businesses were there on the other side.
Kane, you admitted something.
No, I don't have anything specific. I just wanted to say this was really great, and I got some good stuff and some really good food for thought out of it. So thank you, Patty.
Great. It
thank you, Patty.
was a privilege. Thank you. Thank you, guys.
Right. Thank you all for coming, Patty. Thanks. Go get them, gang.
Of course.
Have a great day.
See you all
You
soon.
too.